Well, hey there, everyone. Happy Monday. It's January 26, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of lovely Redmond, Washington. Talk to my parents who are in the Cleveland area. 13 inches of snow on the ground, more still on their way. So hope you all are hanging in there, staying warm, staying safe wherever you're tuning in from. I know a lot of the country's struggling with some winter weather. Here in the Pacific Northwest, it's pretty normal, kind of highs around 40 probably, and just slightly damp, but not too bad. Doing okay. Hope you guys are all doing well. We're pretty excited here in the Seattle area after our Seattle Seahawks making it to the Super Bowl for the first time in probably too many years. 2014, I think, was the last time they were there before our arrival here in Seattle. But we're super excited to see the team back there. Market conditions. I mean, decent day. I was thinking this might be that day where we close above 7,000. Didn't end up being there. We topped out around 69.65 or so. Dropped in the last couple of minutes of trading. We closed around 69.50. We're very close to that 7,000 level. Stocks still, generally speaking, remain in a position of strength, particularly when we're looking at the S&P 500 and the NASDAQ. Certain stocks continuing to show quite a bit of strength. Some technology stocks, which I could highlight for you, even some consumer staples names, like one that I remember hand selecting a couple hours ago to include in the discussion. Having said that, right, I think when the market is in a position of strength, we always look for signs, or at least I was trained to look for signs that something's different, right? Always be looking for signs of something that could help us understand when a top is forming, either an alert or a signal before the peak to help us kind of get prepared for it, looking for conditions similar to previous peaks. Maybe it's more of a lagging indicator, acknowledging when a peak has occurred. Maybe it's more breadth indicators and divergences, which tend to kind of happen as a top is forming. So we'll talk just briefly about volume today, because the Chaikin Money Flow just finished slightly below zero today by my reading. And while that's not necessarily the end of the world, it tells you maybe that the volume here in January so far has not been particularly robust, and that could be part of a story where the market is maybe nearing a peak. Generally speaking, again, as a trend follower, trends are strong, right? As of last Friday, our market trend model remains bullish on all time frames. I've learned not to get too negative when that's the configuration. But I will leave it to you. We'll share with you some of the key charts, some of the key levels, some of the key patterns we're seeing. Leadership rotation with utilities at the top of the leaderboard today. Number of charts to talk through with you. Let's go to it. By the way, thanks again, everyone that shared a question last week on our YouTube channel. We had a great all mailbag episode on Friday. I hope you enjoyed it. If not, please go back and check it out. 6 really great questions from your fellow viewers. Can't tell you how much I appreciate hearing feedback, but especially questions that we can consider in our next mailbag episode, which will be scheduled for Friday of this week. All right, looking at the charts here, we can see that the S&P 500 up about 0.5% into the close. So Friday, remember Thursday and Friday, kind of choppy sideways sessions. Thursday, we kind of traded up and then consolidated. Friday was a full sideways day. The question was, which way do we move with the new 5-week trading here, and or 5 days of trading, and it was a nice acceleration to the upside. S&P reacting quickly in the first 30 minutes of trading to push from 69.15, we'll call it, which was Friday's close, up to around 69.50. From there, kind of chopped around to settle in. The Dow and the NASDAQ all around the same, right about 0.5%, although the Dow was slightly stronger. Mid caps were slightly lower. Small caps were basically flat for the day. So mids and smalls didn't really participate. The juice was in large cap, and not necessarily growth or value. Kind of everything did okay when you look at the different indexes. The VIX really wasn't much changed from Friday. It moved around a bit, but the volatility pretty consistent. The VIX is around 16, just slightly above there. And that's a low volatility environment, anything below 20. Options markets telling you not much to worry about. Expect lighter moves, which is kind of what we saw today with the S&P up about 0.5%. Looking at the interest rate environment, we can see that the curve generally drifting lower today. The 10-year yield finished around 4.21. The long bond yield is just above 4.8%, and the 5-year point just above 3.8%. So we still have that normal shaped yield curve. It's becoming more and more normal shaped as the short end of the curve comes down. This week is Fed week. A couple of big things happening this week. The Fed meeting honestly may end up being a bit of a non-issue. We'll see what happens because you never know, and certainly everyone will be hanging on every nugget of color we can get in terms of hints at future interest rate policy. However, market pricing in essentially no change to the Fed target rate here at this meeting. We'll see what happens in terms of expectations for subsequent meetings in Q1 and maybe into Q2. But having said that, the environment here is, the short end of the curve kind of coming down gently and slowly as the Fed's lowering rates. The long end of the curve had been going higher. It's kind of stalled out a bit, and bonds, rates coming down a bit through the course of last week. Today, the TLT up about 0.5%. So that's a bond, an ETF that tracks bond prices. So having a nice up day, and that coincides with rates sort of coming down here. Certainly something we'll be talking about Tuesday into Wednesday, what to expect with that Fed meeting and what that could mean for the interest rate environment. The dollar index down again today, and that weaker dollar has been one of the biggest shifts, right? When we think about changes, I think a big part of your, at least my goal as a technical analyst is to review charts, review trends, but focus on things that are different, right? What's new, what's different, what's changing, what we call a change of character, right? Something that was in an uptrend, now in a downtrend, or vice versa. The dollar reversal has been one of the biggest shifts, I would say, here in the new year, and certainly since last week, since the initial reports out of Davos early last week. Dollar gapped lower, and we've seen continued move lower in the dollar into today as well. So weaker dollar, essentially implies a lack of confidence in the U.S. system versus elsewhere, and you're seeing most currencies, a lot of currencies relative to the U.S. dollar are strengthening. So it's sort of a broader decline. Generally, it's hard to say, is that a good sign or a bad sign? Because there's a lot of moving parts and everything, but I would say at this particular point, the weaker dollar would seem to me to imply a lack of confidence about the U.S. markets. And the problem is, I think the U.S. markets in many ways have thrived because of investors outside the U.S. seeing the U.S. as a great place to be. And if that starts to shift, if that's one of the ways that this whole geopolitical stuff evolves in 2026, I don't know how that would come out as a great thing for the markets. Now, there are other things that can make the markets go higher, but the weaker dollar would seem like an issue to me. We'll see what happens, and I'll certainly look to bring on some great guests onto the podcast. One of the great advantages I have with what I do, I would say, is that I can analyze charts pretty well, and I'm pretty decent at that, I would say, in terms of my ability to understand things from a technical perspective. But I'm not an expert in all things. I'm not an economist. I'm not a fundamental strategist, right? There are things that I'm familiar with, but they're not what I do day in and day out. So I've learned to talk to smart people that have focused their careers on those other things, and we compare notes. And I've always found those discussions to be very fruitful. I've got a podcast where I can bring people on to ask them about the Fed and the dollar and all those sorts of things. So if there's any experts that come to mind that you think would be great to bring on to talk about a weakening U.S. dollar and what that might imply, please drop a comment on our YouTube channel. I'd love to see what ideas you have, and happy to approach anyone to see if I can get them on for a good conversation about things. Precious metals continuing to be the juice here in 2026. If you thought silver had a strong 2025, which it certainly did, outpacing the S&P and the NASDAQ by far, it's happening again so far in the first month of 2026. Silver has been ripping to the upside. Gold has been strong as well, but not as parabolic. I grabbed the weekly chart of silver to show you how much it's moved relative to previous cycles. It's been a pretty significant move. You have to go back pretty far on the chart to find previous times where we've had this much of an acceleration in silver prices. And the reasoning there, I would say probably a couple things. Number one, it's just something that's gone up a lot, and that's drawn a lot of people into the trade most likely. Number two would be the idea of a safe haven, right? Precious metals tend to be thought of as something that would be good when conditions feel uncertain, and that's certainly something that many investors are considering here in these days. And then the third thing would be there actually are some practical uses for silver in terms of technology and EVs and things like that. And so there's practical application, not as much for gold, but definitely for silver. So those things are combining to into a chart that looks remarkably strong. Energy kind of mixed today. You can see crude oil prices slightly lower, natural gas pushing higher. Cryptocurrencies all in the green today. Bitcoin is currently trading just above 88,000 as we're recording our episode here after the U.S. equity market close. Choppy weekend, to be honest with you, and it looked like it might be a big acceleration lower. Bitcoin actually touched 86,000 in the last 24 hours, but nice bounce up to around 88,000 plus, which is where we're currently observing it. It's a sideways chart, to be honest with you, is the way I would generally describe that. I think I grabbed the chart of Bitcoin to review with you here when we get to the chart review portion of the episode. All right, looking at the 11 S&P sectors, 8 up, 3 down. So that's pretty decent in terms of sector performance. Utilities at the top of the list, up 0.7%, about the same for communication services and technology. So those three almost identical returns leading the market higher. What's interesting here is no sector was up more than utilities, 0.75%, and that's it. So this is a low movement day, which again is what the VIX down around 16 kind of implies. We shouldn't be having moves over 1% on a trading day, is what the options market is basically pricing in here. And so today's returns kind of fit into what the options market is telling us. The only real area of weakness today, consumer discretionary, which was the XLY was down 0.7%. I saw Tesla was down. We'll look at the heat map and dig a little deeper into what may have caused that particular move. But the other consumer sector, which is consumer staples, more on the defensive side of consumers, down 0.2%. Real estate and energy were basically flat today. Looking at the breadth, more negative than positive when you look at the New York Composite Index, certainly the NASDAQ. But to be honest with you, the NYSE was essentially exactly the same, right? 49% up, 49% down. That's a wash. But look how the S&P much more skewed positively. So the rest of these more neutral. The NASDAQ really more negative, and the S&P more positive. So generally, a little bit of a feel of growth over value when I look at those. But with the NASDAQ, not as much. This is weird, right? This is like the mega cap names doing well. And so I would generally probably describe that. Interesting. Interesting to see the breadth so different. I'm going to assume that data is all true. And if so, kind of a weird day, that much of a disagreement between the breadth ratings. Looking at the Magnificent Seven and friends, we can see Apple and Meta up. Apple was up 3%, Meta up 2.1%. Alphabet having a nice day as well. Alphabet, I would say, by far the strongest chart in this basket, just in a nice steady uptrend. Meta rallying up to resistance, and now the question is, do we get above key resistance? I did grab that chart to review with you here in a moment. Tesla down 3.1%. That's dragging down consumer discretionary. Amazon, which is also obviously one of the big weights, down about 0.33%. Netflix and Nvidia, both in the red today as well. All right, let's go to the heat map and talk about what's happening with groups and sectors and themes. As a reminder, please take a moment, if you could, drop a question in the comment section on our YouTube channel. I have not thought about this week because I'm traveling quite a bit. The next couple of weeks, my daughter is a senior in high school. She's doing auditions at a bunch of music schools around North America, to be honest with you. So over the next couple of weeks, I'm working on some personal travel. I'm super thankful that what I do professionally allows me some flexibility to be in different locations. I will ask you for some flexibility as I get to the show when I can and slot it into other things that I'm doing with some trips coming up here. So I actually think I'm going to be traveling on Friday. But I'll see what I can do and certainly get you a good mailbag episode when time permits. But in the meantime, hey, always a good time to drop a question on our YouTube channel. I read everything that comes in, and would love to feature one of your questions on the show. Last Friday's was a really good one, and I hope you can check that one out. Looking at the heat map, I mean, not a bad day, right? Particularly in the growth sectors, right? So if you look at the top two sectors in terms of weight, that's technology, which is by far the biggest sector. And then you have communication services in the lower left. And if you look at technology, I mean, generally pretty good, although there's some big red boxes here. And this is just today's returns, right? Intel down over 5%. Now, Intel had earnings last week, and it didn't go great. I mean, the quarterly number was fine. It was the forward-looking guidance, and basically, I mean, the way I would summarize what I read, my understanding is, not enough chips to keep up with demand for all the AI infrastructure stuff. And I mean, that's kind of one of those great problems to have, right? More demand than we can supply, but it, excuse me, also means that they're leaving some revenues on the table if they can't actually bring the supply to meet the demand. So Intel down on Friday, down again today. I was wondering after Friday's drop if you'd see some buyers come in and buy on weakness today. Didn't have it. Elsewhere in the technology sector, sticking with the semiconductor theme, you have AMD, which is still a pretty good chart. I mean, this is a stock that pulled back to 200, now up to test the previous peaks. It's sort of like a double top pattern until proven otherwise. Makes me think of Microsoft back last year, where you had the peak in sort of early August and then late October, and that ended up being the peak for now. I'm not going to say that that's definitely what's going to happen to AMD, but that definitely popped in my mind of a double topping technology stock. It didn't go well the last time. We'll see what happens. And if there's enough to push above that resistance, I would say that'd be quite good. Micron moving down here along with AMD. Now that made a new all-time high last week, so I'm not too concerned about that chart just yet. Still in a nice uptrend phase. Now, otherwise, a lot to like when you look at what happened today in the technology sector, particularly semiconductors outside of the ones that we just talked about, having some nice bounces with LRCX, KLAC, both up a couple percent today. Where else can we look? In the middle, so consumer discretionary, the worst sector here, Tesla down 3.1%, is kind of that big, obvious name that pulled back a bit. It's sort of a mixed group of other things kind of coming down here, like an Alta, which is just pulling back after making new highs. Tapestry is one of those. I think the chart of Tapestry is one. This is ticker TPR, and this is in the clothing and accessories group. The chart of TPR might be an interesting one to reflect on, and I don't have a position in TPR to speak of, but this is one that's arguably right at that point where it's gone from being a clear uptrend phase to being in a pullback situation. And, is it completely obvious yet? I don't think so. But let's talk about this one for a minute, because I think it's a good kind of case study to talk about, right? So I think of charts in one of three phases, and I'll simplify by saying it's going up, it's going down, it's going sideways. And I don't think you need to make it any more complicated than that. So the question is, on a chart like Tapestry, how do you know when it's when it's transitioning from going up to going down, or what I would call an accumulation phase to a distribution phase? What happens? So there's a group of indicators that are more leading indicators that help us anticipate a potential peak. The most obvious one of those is called a bearish momentum divergence. That's when the price goes higher, but the momentum slopes downwards. And just on this chart, I can see a couple examples of that, right? Like here, I meant for that to be red. Here, where you've got the price moving higher, you see the RSI sloping downwards. You can kind of see that again here, where the RSI is sloping downwards, all the price is making new highs. And the bad news is we've got that another whole set of that right now. So what does that mean? So in a healthy uptrend, you'll see a price moving higher on strong momentum. We want to become overbought on those big upward thrusts, because that implies that there's a bunch of buying power, a lot of optimism fueling that uptrend. Toward the end of a big move higher, we'll have a divergence start to go where the price keeps moving higher, but the momentum slopes downwards. And that's often created because you'll have these big kind of distribution days, or just spent enough time kind of drifting higher that the momentum naturally starts to decline, just the way that the indicator is calculated. But more often than not, it's a good sort of signal that starts to trigger as we're approaching a major peak. Once that triggers, which I think it did a couple weeks ago, we then have to transition to more lagging indicators. All right, what are the indicators that tell us that was a peak and now we're in a downward trend? And I would say, for me, breaking through the 21-day EMA is often an initial measure of that. Breaking through the 50-day is a clear violation of support. The RSI breaking below 40, which would tell us we're more in a distribution phase. Those are the things that tend to coincide with a big drift lower. And then hopefully you're either out of the name or defensive, and then you're looking for some sort of bottoming opportunity. And that's a separate set of things that we would talk about. But in terms of defining a top, this divergence tells me that we're probably in some sort of decline here, just getting started. the way that you would confirm that is if the RSI breaks below 40, if we start to distribute a little bit further, and I would say breaking the 50-day would be a great potential signal. So what do you do with that, right? So if you're all bullish on Tapestry for whatever reason, you think their business is great and you're just not sure why the price is going down, maybe this tells you to be patient and look for some sort of buyable dip, right? Buying on weakness, and buying into a divergence usually means once you enter the trade, you're going to be faced with a pullback. So why not wait for that pullback? Why not wait for that better opportunity to sort of get in and buy on weakness? That's your quick take on charts like Tapestry. I think are great examples of maybe the beginning of a rotation. And I think that's the game. I think that's where the technical analysis toolkit can really help a lot of investors is just help to think about the tactical side of things. Even if you're more of a position trader, just being a little more optimal about when you're adding to positions, when you're patiently waiting for a pullback can make a big difference over time. So that's one that certainly looks to be in a bit of a pullback mode to start here. I think that's it. I want to get to the charts because I hand selected a bunch of charts. We're in the meat of earnings season this week. So as the week goes on, I'm going to be selecting some earnings related names to highlight for you and kind of talk about. But for now, I'll just recap by looking at the S&P 500. As we get to these charts, as a reminder, the podcast has been kicking off here in January, I think really, really well. Some fun interviews last week that I hope you can take a time to review. Joe Rabel gave a little mini masterclass on trend following, on momentum investing, on using technical analysis as a stock picker. Ted Hicks at the end of the week gave a wonderful take on using technical analysis as a financial advisor, how he uses charts to enrich communication with his clients, and some lessons learned of applying technical analysis for allocation, for positioning, and so forth. Really good nuggets of wisdom from both of them, and I'd encourage you to review both of those episodes that aired last week. We've got 2 good interviews signed up for this week and some really good ones slated for the month of February. I'm excited to bring those to you. All right, chart of the S&P 500 with today's nice rally, while not above 7,000 just yet, is back into the green portion of the chart, which for me says green light. That means we're in pretty good shape. This is a risk on type of area if we're here. And again, anything above 6,900 at this point is pretty encouraging. Anything below 6,900, but still above 6,550 is yellow light. That's okay. And anything below 6,550, I think would be pretty bearish in terms of the structure. For now, we're back into that bullish range. Means the trend is positive. And again, as a trend follower, I haven't seen anything remarkably concerning from the major averages. It's kind of fluctuated from great to pretty good, and pretty good is still pretty good. And the momentum honestly has been neutral since for the last couple months here. RSI has generally been between 40 and 60, which speaks to a pretty even momentum. Up days and down days are fairly even. Neither buyers or sellers really taking control. I'll let you know when we change and get out of that pattern, but that's how I'm reading things right about now. Yeah, in terms of breadth, we've covered breadth indicators pretty closely in our work, and was going through them in detail with our premium members over the weekend. One thing we haven't talked about on this show in a little while is volume, and I just want to show you the Chaikin Money Flow. This is an indicator created by Mark Chaikin. It's basically an oscillator driven by daily volume ratings, but the daily volume rating, instead of just being how many shares were traded on the day, and was it like an up day or a down day, which is what on balance volume does. Chaikin Money Flow goes sort of a level deeper, and it says, all right, where did we close versus the high and the low for the day? And that tells me how important today's volume was. So if we had big volume, but we ended up at the middle of the day, it was kind of even between kind of buying pressure and selling power. So it's kind of even. It's not really, the money flow was not significant. But if we close near the highs of the day, most of that day's volume was pretty bullish. And if we close near the lows of the day, most of that day's volume was more distribution, more bearish. And so it's a great way of kind of tracking the general trend in volume and see if it signals more accumulation or distribution. Has a 1 month look back in terms of the version that I use, a 21-day look back. So as of today, it's almost exactly at the zero level, which basically means over the last month, the volume has been even between, and again, I'm sort of summarizing the math here, but it's kind of even on up and down moves, right? The volume has not been overwhelmingly bullish or overwhelmingly bearish. Now, generally, since the end of October, the indicator has been, gently positive, but with some frequent pullbacks back below the zero level. Those ended up being some pretty decent buyable dips on the way up since Halloween of last year. Does that mean if we dip below zero, that's going to be another buyable dip? Maybe. And I think that's where you want to think about other indicators as well to see what that means. But when the indicator dips below zero and then dips back above, that's usually a pretty bullish sign because that tells you there's some accumulation happening. For now, it's dead even. And I think the danger here we start to get more red here, which would indicate more distribution as the days progress going forward. So something we'll keep an eye on for now, not horribly negative, and it's looking very similar to some pullbacks that we experienced in November and December. I'll tell you one chart that has reversed quite a bit here in the last week and a half now, the US dollar, which was trending higher back up toward the 100 level, which ended up being resistance a number of times in the latter half of last year, really rolled over since the Davos, the economic forum, and continuing here today with a gap lower on the dollar index, which is $USD. On the stock charts platform, on other platforms, it has a ticker like DXY. So I would look, whatever charting platform you use, there's no real generally accepted framework to refer to something like the dollar index. So every platform has a different ticker for it. It's just one of those annoying things about how things played out here as an industry. So just look for something like the dollar index or dollar spot. And it should give you something that looks kind of like this because it's available in a lot of places. So the dollar rotating lower means the dollar is weakening versus a bunch of other currencies. And, in this kind of environment, the movement in the dollar most likely implies confidence or lack of confidence in moving money into the US or out of the US. And so the fact that the dollar is going down just means there's not a lot of demand for dollars. And basically means that we're not seeing a big move into U.S. markets as a safe haven kind of play. That could end up being quite an issue. For now, it's something I think to be aware of. Now, one great outcome, if you like commodities, is that a weaker dollar usually coincides with commodities going higher, although not always, but definitely that's what's happened here in the last week. Crude oil prices are pushing higher as crude oil tests $62 a barrel. Gold continues higher as it closed above $5,000 an ounce for the first time in history today. So a nice uptrend in gold, which has remained in a nice uptrend for quite some time. Now, while gold is something that I have in my accounts through GLD and IAU, I don't think I have other gold things at the moment. I might have one of the gold stock ETFs or, like a gold miners ETF, but I don't believe I do at the moment, but I definitely have a gold position. The other thing to point out would be silver, and silver has just accelerated to the upside. It's gone vertical. It's gone parabolic. This is a weekly chart for the last 20 years or so, just to bring in quite a bit of data. And the reason why I'm doing that is just to show you how 2025 and continuing into January of 2026, what a significant rise this has been, right? And I think what concerns people, which is fair, is that gold has gone vertical before. It's gone exponentially up. And it usually stalls out and eventually hits a peak and ends up chopping around for a bit. And we saw that in 2020 coming out of the COVID low. We saw that in 2011 after gold ripped higher in 2009 and 2010. That was coming out of the financial crisis. And then from there, it kind of stabilized and then generally started to trend lower. Now, silver prices have accelerated to the upside here. And here's what I would tell you, right? I mean, there's a lot of things to think about here, but I think from a technical perspective, how do you make sense of a chart that's gone vertical? Here's what I would tell you. On the weekly chart, look at how high the weekly RSI is. It's up around 90 almost. And it's not often when the weekly RSI gets up that high. In fact, it's the only two times that's happened in the last 20 years has been those two times that I've just mentioned to you. And also back here, by the way, in 2006, just on the very left side, where you had these big kind of exponential rises. The RSI gets around, 80 or 90. And that tells you we've had a significant move. Now, more often than not, the end of that move is pretty close when you get an RSI up to those extremes. And I can't guarantee that's going to happen today, but it is, giving similar signs to previous very extended kind of conditions. So you can, try to sell into that strength if you like. The other thing to think about, though, from more of a structural perspective, if you look what happened after every one of those peaks, right? In 2011, we had that big peak as the as silver got to around $50 an ounce. Then we pulled back, and instead of it making a new high, we made a lower high on weaker momentum. Here in 2020, coming out of the COVID low, we made that extreme move higher. We then pulled back. We retested the high, did not make a new high on weaker momentum. And I think the consistent feature there is the fact that the momentum was weaker on that second peak, right? Whether it's a double top where it's trying to get back to the previous high, or whether it's a lower peak, what was consistent there is that second peak after what ended up being the top, there was a secondary peak where the momentum was a lot weaker. And I think that would be a dangerous pattern to look for here. Because if you look back in history, that's been the time when you want to kind of get out of the way and be patient and wait for some recovery that happens, in some cases, weeks, if not months later. For now, it's still in a primary uptrend, making higher highs and higher lows. But again, I'm immediately looking back to some of those previous peaks. I would encourage you to spend some time with chart of silver and gold and look at some of those previous times when it's been overextended. All right, bear with me on this one. There's a lot of squiggles on this chart. I hesitate. This is kind of way past the amount of squiggles that I like to have on a chart. As you may know, I like to keep things simple. And I apologize. I'm giving you like this is actually my workbook chart. So I have a set of charts that I show on the show, that I show in presentations, which are super clean, because a big part of my career has been spent taking charts that are at times very complex and trying to simplify them and explain them in ways that resonate with someone that is not as familiar with that. And if my attempts to do that through this show have been helpful for you, I'm super happy for that. That's what I'm trying to do. But every once in a while, I want to give you kind of the raw stuff and just show you behind the scenes, like what kind of things you can use to try to understand things a little more deeply. So I apologize for all the wiggles and squiggles. I'll focus your attention on the bottom panel. And if what I'm about to show you doesn't make sense, please watch the video with the podcast interview with Joe Rabel last week, because one of his favorite indicators is the ADX line, the average directional index, or average directional movement, it's called. This is an indicator created by Wells Wilder. He's the guy that created RSI as well, which I use all the time. I don't use the ADX as much, and the ADX is made up of the two directional movement indicators, which are in green and in red. I'm going to just briefly explain this to you, and I'll show you where you can find more info if you want to learn about it. And again, I'd encourage you to check out the podcast interview with Joe, because he explains a lot better than I will why he uses the ADX line and some of the other indicators with a good recent example. Also, his show on Stock Charts TV, he often features this indicator. So if it piques your interest, check out his work. He uses it more often and better than I do. But the directional movement index is basically made of this green and red lines. And so the way that I learned this years ago is that the green, in an uptrend, we have higher highs, right? In a downtrend, we have lower lows. So what the directional movement index basically does, and I'm summarizing the math here, the green line kind of tracks the highs, the red line kind of tracks the lows. So if the highs are getting higher over a period of time, the green line is going to be going up. If the lows are getting lower, the red line is going to be going up. So if the green line is up and the red line is down, as it was about a week ago, that tells you positive directional movement, because green is well above red. The ADX line is going up, which means the trend is strengthening. The opposite would be the red line high, the green line low. That means we're in a primary downtrend because the lows are getting lower. The improvement in the ADX tells us that the strength of the trend is accelerating. So this is what the indicator looks like when we're in a primary downtrend, like we were in early November. This is what the indicator looks like in mid-January. We're in a primary uptrend. But if you look at what happened about a week ago, we flipped from bullish to bearish because the red line crosses up through the green. And what that means is the lows are starting to get lower again and the highs aren't getting higher anymore. And that coincided with this rotation lower. As the trend is pulled back, we can see the ADX line is coming down because the strength of this trend is starting to dissipate. The reason why I'm showing this on the chart of Bitcoin is because it's been in a choppy kind of transition. I got really excited when Bitcoin pushed above 95,000. So excited, by the way, that I took a position in GBTC. I still own part of that position, even though it's come down quite a bit and past my initial stop. I'm still holding on a bit to see if it recovers. Having said that, one of the things that I think would validate potentially a new uptrend, similar to what we saw here, right? So it's sort of like a we are here, where we have the red above the green, which means we're in a downtrend. We have the ADX coming down. The buy signal is what you see here when the positive DMI crosses up through the negative. So green crosses up through red. the black line starts to turn higher. This configuration in early January was a flip from a downtrend to an uptrend, and then a strengthening trend with the ADX going up. That's what I'd be looking for here, just as a way to sort of track more of a systematic way of saying, all right, this thing's choppy and sideways. It broke out, then it didn't. Give me some signal when the trend starts to improve. This might be one of those times to use the Wells Weiler's directional movement index and its complement, the ADX line. If everything I just showed you made no sense at all, take yourself to stock charts, go to Chart School, and then go to the articles and type DMI or ADX, and you'll get to some really good articles that explain with good examples of what these indicators are and how to use them. All right, let's talk about some individual stocks. We'll call it a day. Meta testing resistance. I'm going to go lightning round because we're a little long on time. Meta testing resistance. This is one of the many Magnificent Seven names reporting earnings this week. About half the Mag 7 names reporting earnings this week. Meta is slated for Wednesday. Nice bounce off of the 600 level, which is a Fibonacci level. Bounce up to the 38.2% level, which is another Fibonacci level. This is where we stalled out in December. This is also the 200-day moving average. Meta above 675 is a pretty decent chart, I would say, because that means we're breaking out of this consolidation phase and most likely into a new accumulation phase, assuming that the RSI pushes above 60. We're right at that point. Bad earnings can kill a promising chart, though. I've seen it happen. So let's keep a watchful eye. But for now, an interesting setup going into Wednesday's release. AMD, as I mentioned, I'm classifying this as a double top pattern until proven otherwise. Proven otherwise for me would be a move above 270. That would be a strong indication of further upside on this name. AMD is set for earnings on Wednesday as well, just coming out of the overbought condition. So a number of kind of growthy stocks slated for earnings. Intel is not an earnings name this week because they reported last week. It didn't go great. Quarterly number was fine. It was sort of the supply side issues that they're struggling with, just keeping up with demand. As a result, big gap lower on Friday. The question for today, after pulling back to the 21-day EMA, did buyers come in and push us higher? They did not, which means I'm watching my first kind of level of support, which is right around 41. The 50 days right below there. If we would break that for some reason, I'd be looking down around 32.50. That would be a 61.8% retracement, and also would bring it down to the November low, which is right around 33. So keep an eye on that level. Goldman Sachs, let's finish with two charts that look pretty good. Now, Goldman Sachs making higher highs and higher lows. That's bullish. Friday, we closed below the 21-day EMA. Today, we actually bounced up a little bit, closed right at the 21-day EMA. Big divergence here on the chart. A lot of financial stocks had divergences going into the beginning of January. Goldman Sachs still featuring one of those bearish momentum divergences, which means similar to previous charts. I think that was Tapestry we talked about. You're looking for that rotation lower. After a divergence, do we break support? And I think keeping a watchful eye on support levels would be important. The momentum is still quite good with the RSI still above 50. So no concerns on momentum, just that leading indicator telling me maybe be concerned a bit. Hey, when the going gets tough, the tough get eating, smoking, and drinking. It was a famous quote by Alan Shaw. And I don't know if he originated that, but he loved quoting it, at least in my experience with him. He passed away a number of years ago and was one of the greats of probably two generations ahead of me in the technical analysis community. One of those sort of great sell-side technical analysts that ran the group at Smith Barney, and which turned into the group at Citigroup over time, run by Luis Yamada. But never forgot that quote about looking at defensive sectors and defensive plays, particularly tobacco names, which have been fantastic charts. Flip the chart of Tapestry upside down, and you see an example here of a chart that was in a distribution phase, now switching to an accumulation phase. Lower lows to higher lows, below the 200-day to above the 200-day, momentum in the bearish range to the momentum in the bullish range, the relative strength improving. Great chart, making another 3-month high here today as the S&P was up a lot less. So impressive rotation charts like that, I think, innocent until proven guilty, as I like to say. Folks, that'll do it. Thanks so much for joining me here on Monday, January 26th. A lot of charts to talk about this week between earnings and the Fed. We're going to have a lot to cover. We've got a couple good interviews for you with the Market Misbehavior podcast, but we'll be here the whole week tracking things. I will be traveling at the end of the week, so I'll keep you updated when I figure out exactly what I'm going to do with this show. But in the meantime, Have an awesome night. Thanks so much for watching. Please tell your friends. It would be great to have them here as well. I'm Dave Keller with Market Misbehavior, reminding you as always, it's always a good time to own good charts. Have a good night, folks.